Nobody talks about the clause buried inside your life insurance policy that could let you collect your own death benefit while you're still alive. And once you find out it exists, you're gonna wanna know exactly why your agent may have glossed right over it. We're talking about accelerated death benefits and living benefits. Two features that sound like insurance marketing fluff until someone you love gets a stage 3 cancer diagnosis and suddenly needs $80,000 in 6 weeks. The stakes here aren't theoretical. They're the difference between financial survival and total collapse during the worst moment of your life. Now, to understand why this conversation even exists, you have to understand how life insurance companies think, which is essentially like a casino that only bets on one thing when you die. Living benefits flip that model on its head by saying, wait, what if the policyholder needs the money before they die? And that tension between profitability and humanity is exactly where the premium debate was born. The catalyst for mainstream adoption was actually the AIDS crisis of the 1980s, when terminally ill patients started selling their policies on what became known as the viatical settlement market just to afford treatment. Insurance companies looked at that underground economy and said, fine, we'll build something structured and accelerated. Death benefits were formalized into most policies by the mid-1990s. Here's where the optimism gets complicated though, because early versions of these benefits were narrowly defined, requiring a terminal diagnosis with a life expectancy of 12 months or less before you could touch a single dollar. Fast forward to today, and the newer generation of living benefit riders can trigger on chronic illness, critical illness, or even permanent disability, which sounds incredible until you read the fine print and realize the definitions vary wildly by carrier. And that variance is where smart people get burned, because you might assume chronic illness means needing help with daily activities when your specific policy defines it as needing help with 2 out of 6 activities of daily living for 90 consecutive days. The gap between what you imagine and what the contract says is where tens of thousands of dollars quietly disappear. Now, let's address the biggest misconception head on, that living benefits are free, which some agents pitch as a major selling point. Almost every meaningful living benefit rider either comes with an explicit monthly charge, an acceleration charge when you access the funds, or a reduction in your death benefit that leaves your beneficiaries holding less than they expected. The real question isn't whether these benefits cost money, they absolutely do, it's whether the cost is proportionate to the risk you're actually hedging. Statistically, 1 in 4 Americans will experience a disability lasting longer than 12 months before they reach retirement age. And the average critical illness diagnosis, like a heart attack, stroke, or cancer, carries out-of-pocket costs that can exceed $150,000 even with good health insurance. History teaches us that people dramatically underestimate the probability of needing these benefits and dramatically overestimate how well their savings will hold up during a health crisis. The cautionary tale here isn't the person who paid the premium and never used the rider, it's the person who skipped it and spent their kid's college fund on hospital bills in year 4 of a chronic illness. The practical framework is straightforward. If you have less than 6 months of expenses in liquid savings, living benefits are not a luxury, they are infrastructure. If you're already adequately self-insured with significant assets and robust disability coverage, then the rider math may not pencil out, and that's a rational conclusion, not a failure. What nobody tells you is that the real value of these riders is often psychological. Knowing the option exists changes how aggressively you can pursue treatment without financial paralysis. There's something deeply rational about buying a feature you hope you never use, the same way you buy a fire extinguisher and hope your kitchen stays boring. The discipline here mirrors every other area of personal finance. It's not about predicting whether you'll need it. It's about building a system that doesn't collapse when reality deviates from the plan. Sizing matters too, because overinsuring with expensive riders on a policy you can barely afford creates a different kind of financial fragility. So the philosophical conclusion is this: living benefits are worth examining seriously, worth comparing across carriers, and worth running the actual numbers on rather than accepting a blanket yes or no from someone with a commission incentive. Discipline means you read the definitions, you model the cost against your specific risk profile, and you make a decision grounded in your actual financial architecture, not fear or hype. If you're sitting on a policy you haven't reviewed in 5 years, or you've never had someone walk you through what your living benefit rider actually triggers on, that conversation needs to happen before a crisis makes it urgent. Comfort comes not from hoping nothing goes wrong, but from knowing your plan holds whether something does or doesn't. Whatever direction you land on, we're here to help you think through it clearly. And if you're also exploring real estate investing, need home contracting work done, or are looking to connect with the right lenders, check out our links in the description below.